Hey everybody, this is Jose Blasco. How are you, my friends? We are about to get started. Just a few seconds before we start, as always, it would be good to have a quick sound check confirmation. A quick message on the chat box would do. Quick hello on the chat box is a nice thing to do. And now I know you hear me well. So please do that so we can start in just a few seconds. Thank you so much. Almost there. Yeah, here we go. It's the top of the hour. It's time to get started, isn't it? Welcome to the session, everybody. Today it's March 3, 2022. My name is Jose Blasco. This is Options with Options. The name says it all, isn't it? We're going to be jumping in the markets, looking for options opportunities, looking at what the options markets are doing, and see what is it that we can do to find high quality opportunities by following a set of rules, and we apply them mechanically. Before we get started, thank you so much, Christian, for confirming the sound and everyone. Before we get started, I would like to highlight the disclaimer. As always, please read it carefully. This is important information. It's fairly short, so I'm counting on you all to read it completely because, again, it's important. So please do that. As we are completing the highlight of the disclaimer, I would like to mention the agenda for today, which is our usual process, if you wish, which is about looking at the market, understanding what's happening out there, which lots of things are happening, isn't it? Look at trades that we have placed in the past and talk about their management, and from there look at new market opportunities. How are you, Mark? It's good to see you. Very nice, everybody. So I'm just gonna close this one and also highlight very quickly our question page. By the way, Mark, you got a response a bit earlier in the day. You may have seen it already. So the question page is a fantastic place for you guys to post your questions. But even before you post the questions, you may want to search, because there is a search box, isn't it? And maybe your questions have already been answered. So do a search. You may find your answers. If you don't, log in with the purple button, click on the green button, ask your question. You can upload screenshots of your charts. Be detailed, please. And then we'll get back to you with answers. And by the way, when I say we'll get back to you, that's our support team. But keep in mind that anyone could comment and collaborate, and this could be an open forum if you guys feel like it. So feel free to participate of those conversations. Nice. Okay, so let's begin with our market analysis. Okay, we have the S&P. Today I'd like to start, if you don't mind, I'd like to start with the VIX. Just because obviously the VIX is trading at 30 something. We got all the way to 37 in the past few days, so I wanted to point at this fact. Obviously we all know the reasons behind this, isn't it? The crazy, just to use a word, the crazy events that are happening in Eastern Europe obviously are the reason for so much fear in the marketplace. Volatility increasing so much, which it's obviously also the source of opportunities, depending on the type of trades that you perform when you do your options trading. So I wanted to point at the fact that the VIX has been growing. Last week already, when we talked about it, I believe actually it was around 30 when we did the session together. So we are more or less at the same levels. But again, this is pretty high VIX, that we haven't seen for a while, and it seems to be quite sustained in the 30 plus range, meaning that there is real fear in the marketplace. When going back to the S&P and we look at auto climate, which is where we normally start our analysis, right? So notice that we have a blue dot. And by the way, I haven't done it on purpose, but I believe that the last week when we met, it was the same, if I'm not mistaken. We had a blue dot, but it's a thin blue dot, and that means that the climate is not confirmed. There is not enough definition when it comes to price movement. The market is not impulsive enough to call this market condition a tradable market condition from a probability standpoint. Anything could be tradable, but auto climate is telling us that statistics are not on our side to be aggressively directional. That's what I'm trying to say. Now, obviously, if that dot becomes thickened, like for example those blue dots here. So if that dot changes from thin to thick, next thing you know, we are in a blue climate, which statistically could last for 6 candles, and therefore there is money to be made to the upsides based on such statistics. But at this moment in time, since the climate is not confirmed, I guess we don't need to talk too much more about this. It's pretty clear that non-directional trading would probably be the best choice. Okay, probably the best choice from that point of view. Now, there is some minor directional component, hence the blue color. We are above the average. There are UFOs located on the 55-minute time frame right below price. I would really not be surprised at all that price comes to the UFOs, starts moving back higher. 1 to 2 days from now, we have a very well-defined climate to the upside, and we are back in business being directional to the upside. Right now, it's too soon. I mean, we could certainly anticipate this to happen, but odds are not confirmed enough on our side yet to be able to take such risk. So at this moment in time, the idea would be to play non-directionally until things are more defined. Of course, you may be having or maybe running a portfolio with multiple positions already. So, of course, when market conditions move from specific direction on the S&P to non-confirm, obviously hedges are very helpful, because when a market is not confirmed, two things may happen. It confirms in that direction or it confirms in the opposite direction. And if you are too heavily positioned because of prior positions that you already have in your account, this could be a problem. Okay, so make sure that you position yourself properly given that fact. Now, if we read beyond the candlesticks, beyond the bars that we have on our charts, if we read beyond that and we look at the implied volatility, remember the gray line is the implied volatility for the puts, the blue line is the implied volatility for the calls, we can see that since a few days ago, since here to be precise, okay, the implied volatility on the put side is winning, meaning that there is fear in the marketplace, there are more puts being bought than calls being bought, or there are more calls being sold than puts being sold, which in both cases it's bearish. So the component that we don't see on the bars but shows by looking at options data. How are you, Jeff? It's good to see you, my friend. So the component that we can see is a component which is a bearish one. Okay, and in that sense, we gotta be careful again, because now this is a double contradiction. Now the climate is blue and unconfirmed. So again, we already said that betting on a direction heavily, it's against statistics. But on top of that, now if you look at options data suggests that this blue climate is gonna go back to red. Okay, so far we see those green UFOs, which are likely going to push prices higher. But at the same time, options data, which is obviously very relevant, it's kind of revealing the opposite is true, meaning that those green UFOs, those buy orders may end up being canceled. Of course, we're going to have to wait to get a bit more evidence, maybe 1 to 2 days, as I said, to understand better the directional component and therefore, trade in that direction with more odds in our favor. So far, as I said, I believe a couple of times already in the session, non-directional trading is what you will see me do a little later in the session. Now, a bit more analysis here to understand what's happening. So, well, not only the 3-day average of the implied volatility of the call versus puts has the put winning as a 3-day average, but also intraday, the implied volatility for the put is trading at 28, where the calls is 25. It's a 3% difference, which is not a joke, and the ratio is clearly winning in the side of the put, 3 2 3 5. That is quite bearish. Okay, that is quite bearish, and notice I didn't say very bearish. And you would be like, well, why? It's all gray, right? It's clearly gray everywhere. Well, the reason why, and this is a little bit of a surprise, is that even though the market has been open for like an hour and a half already, we have not surpassed the 5-day average on the put in any of the expiration dates. Okay, which that to me is surprising, because there is a lot of put buying, the ratios are great, the implied volatility is higher, meaning that it's put buying, is not put selling, but the quantity of puts is not that large. That's what is surprising to me. So again, lots of uncertainty at this moment in time. If I was to bet on something, given the fact that the climate is unconfirmed and the implied volatility of the puts is surpassing the calls, I would expect red to kick in sooner than later and go back to a down climate. I would expect that to be the case. But again, we're gonna have to wait. I mean, we always need to wait and trade based on evidence instead of a guess. But I'm just sharing those thoughts because it's always a good thing to start anticipating, especially if you have other positions in your portfolio. If you need to prepare, let's say you are a busy person, maybe you have only 1 hour to trade per day, something like that, and you need to start preparing your trades. So again, you will want to anticipate why may be coming as a type of climate. So when the climate confirms, then you can start adding those trades to your account. Cool. Okay, so this is where we're at. Okay, this is where we're at with the market analysis, and I'd like to get some confirmation from you guys. If you could confirm that you are with me, that it's all clear. A quick okay is good enough. You don't need to type anything long unless you have questions or comments that you would like to add. But please, everybody, do not be shy. Give me a quick okay if all is okay, so I know it's all understood. And if you need me to repeat anything, for sure, as always, I'm more than happy to do so. So please be generous with me and give me a little bit of confirmation. How are you, Ahmed? Good to see you, my friend. Thank you for that. Okay, very good. Thanks, everybody. So now, market analysis. Okay, positions, I meant to say. Okay, let's review our positions. So I'm loading here our positions panel. We have an iron condor with FedEx, and we have a double diagonal. Sorry, let me rephrase that. It's not a double diagonal, it's a double calendar with WPM. Okay, so we have work to do here because last week I gave instructions. I mentioned different possibilities, being assigned, not being assigned with WPM. So we need to review all of these. Let's begin with FedEx, and then we'll move to WPM. Thank you so much, everybody, for your OKs. That is very, 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 very helpful. So FedEx, loading FedEx here. Let's see what's going on with FedEx. Here we go. So here is where we are. So last week, if I am not mistaken, we were looking at this trade, and the price, I believe, was there. I believe that was the day when we met the last time. And I was trying to do a butterflying technique to that iron condor, and I could not achieve any pricing that was good enough. Actually, we also analyzed a reverse iron condor instead of a regular iron condor by taking those strikes even lower, right? If you recall, we had all of those analyses done. We found a few scenarios, but nothing was providing, an advantage that was good enough. If I am not mistaken, that's what I remember. So now, why is that? Well, again, time to expiration was very close. If you had done it the day before, probably would have been better, etc., etc. But we also said that, while of course it's not a very good news when we see price. I mean, look at the drop on that stock. Okay, this was supposed to be a non-directional trade. Look at that. Okay, so obviously that stock has been greatly impacted by the geopolitical events. It's like whatever supports were available in the markets, they were all gone, and it felt like crazy from 250 plus to 214 or 210, something like that, 205 actually. So very, very strong drop. So it's never fun to see that happen when you are in a non-directional trade. But at the same time, remember, we set up our trades in ways that, while they're not guaranteed as a profit, it's a smart approach what we do, isn't it? So first of all, below the red line and above the purple line, we had a collection of UFOs that were supposed to stop the price, and it did here for one candle. Okay, it did here for one candle. We were expecting them to go back higher, but it didn't. Okay, so that was a smart thing to have this zone with UFOs in a lower time frame, because this potentially, after the market went against us, could have brought prices back up, but it didn't happen. Again, the geopolitical events have been strong enough for this to be the case. In many other cases, we do see that happen, but not this time. So when that doesn't happen, second shot is to go ahead and utilize the butterfly technique to reduce the risk of the trade and give the trade a second chance. But again, when I did it, it was a bit late, if you wish, because last week we only met once. This week, actually, we will also meet once only. Then tomorrow you have a session with Josip. Do not miss it. And my point is that when that happens, obviously, as a trader, okay, and this happens because again, expiration was very close now, okay, so therefore the amount of premium you get is less. But when that happens, as a trader, you may feel like, oh my god, this is very bad. I'm just gonna lose the whole amount. Well, first of all, think about it. The whole amount you were going to risk in an iron condor is predetermined before taking the trade, right? So if that amount was too large, then you should not have taken the trade. You wouldn't have taken the trade because we are disciplined traders here, right? Now, uh, if that's the case, well, yes, of course, we are reaching the worst case scenario, but it's not the end of the world because we knew the maximum risk ahead of the game, and that is what's going to happen here, right? Now, in the other hand, when price surpasses the purple line, it's kind of like now you got an enhanced upper zone. The zone I mentioned a moment ago, below the red line and above the purple line, the one below, it's kind of like an enhanced zone, which more potential power to bring the prices back higher. And the reason why is because, if you surpass the purple line, it means that in a big, big, big way, that market went way too far, way too fast. You could actually even assess it with the auto climate. So we reached 1.68. Okay, sorry, 1.68 is the two standard deviation of max distance. We reached like 2, which is surpassing by a lot that number. So that market went way too far, way too fast. And when that happens, we often see bounces, very aggressive bounces in the opposite direction, which is what we need to be patient and then reconvert this trade to an iron butterfly. So today, okay, again, we are one day to expiration, so I'm really not sure it's going to work too well. But today we are in a way better position to do a conversion because now the price is 221, which is above the purple line, and now converting the iron condor into an iron butterfly is probably going to produce a good result. Again, we wanted to expiration, maybe not, but certainly if you have done it any of those days, okay, and I would like to hear you guys if you have been trying to do that. I would like to hear your comments on the chat box if you don't mind. And I would like to hear you guys if you were able to manage this switch and convert your iron butterfly, your iron condor to an iron butterfly and get a great amount of premium to offset the risk of the trade and leave the trade with way less risk and now give the trade a second chance to profit after we have been proven wrong, which is the idea of managing our trades. When a trade goes against you, we cannot do anything, like magic, but we can. Options give us options, right? In many cases, we have taken trades that we have then converted into something else, and next thing you know, the trade has lost much less, or sometimes even produced a profit, which that of course happens less often, but it could happen too. Okay, so we're always keen to do that, and it's not always possible, but indeed, options is an asset that allows you to do that. And when possible, we don't miss it. Okay, we love to do that. Christian, you have been trying not possible all week. Got you. So let's try. I'll try today. Again, the fact that expiration is so close, it's indeed a problem. Okay, but let's go ahead and try. So I'm going to start with the position. I'm going to right click on FedEx and click on the risk graph. Okay, so we can evaluate. And by the way, guys, we are working on an update for the risk graph. Okay, as I mentioned in prior sessions, we had a problem with some of the calculations that were happening on the risk graph when it comes to the values on the right menu. Okay, so without making this conversation too long, we will soon have an update released that when you log in, top will auto update where some fixes will be applied to this calculation. Okay. But anyway, so going back to the iron condor, I'm going to compare spread, and I'm going to look at what would happen if I was to close the call side and roll it down all the way, so I create an iron butterfly. So I'm going to do this first. Okay, so I'm going to use the call side. Here we go. So we got 280, 285. So buy the 280 and sell the 285. So that would be like this. Okay, so by doing that, you closed the trade on February 25 for 298 of loss. Got you, Mark. So you had a close as an anticipation. Okay, I get you. Yeah, as long as this is part of your rules, makes sense. Okay, and in my mind, um, again, I'm not saying that this was a mistake or anything like that. I'm just saying, based on my trading style, um, when I commit to the risk of a trade at the beginning, I am committed to it. Given the fact that you have time to expiration left, you never know. You may end up in a profit, right? So I personally don't like to close trades ahead of time unless it's for a profit. If it's for a loss, to me, it doesn't make that much sense. Okay. But Mark, I'm just sharing with you my mindset as a trader. None of us, okay, are exactly the same as a trader because we all have a different mindset, a different experience, a different account size, a different style, a different trading plan, a different everything, right? So, but just sharing with you that again, and sharing with you, Mark, and for everybody, that every time we plan a trade and there is an initial risk for this trade, that initial risk value should be the one that basically tells you yes or no to taking the trade or not taking the trade. You don't want to take a trade with an initial risk which is greater than what you want, and then in the middle of the life of the trade, you start hoping for things to go better because now it's going too bad, or you end up closing the trade for a loss, and then it recovers, and then you miss the recovery. Okay, so just sharing a few thoughts of things I've seen in the past, but again, it doesn't mean that this is exactly your case, Mark. Just sharing out of again, providing you with a bit of experience coming from me. So now, so if we close the call side, so we end up with the orange graph where now the top orange line goes straight. So basically, this is a bull put. So to create now our iron butterfly, I'm gonna have to add two more legs. Okay, two more legs, where one of them is going to be the 235 call, and the one above is gonna be the 240. Okay, so 235 and 240, correct. That would be the one. So that would butterfly the trade. And by butterflying the trade, let's see what we get. Okay. Well, the 235 and the 240, again, we are so close to expression, they only provide 6 cents and 3 cents. Therefore, we are reducing the risk of the trade by, $3 and a half. And therefore, the risk of the trade goes from 395 to 391 and a half, which is extremely little. That is not enough for us to accept. Okay, so it's not looking too good for us to be able to do it. Maybe, Christian, this is the type of problem that you have faced during the week, that you were trying to do that and it's not happening. Of course, if the stock was to rally a bit more, instead of trading at 222, the stock was to have a little bit of a push today or tomorrow and go up to, let's say, 225, 230, something like that, you may get that. That's why I'm saying that a bit earlier in the week, with the stock being a bit higher and a bit more time to expression, maybe there was a chance to do something that have helped a bit more. I'm not sure much more, but definitely a bit more than 3 cents, okay? Because right now it's basically there is no premium left, okay? In any case, let me try to find a better solution, because again, if I use out of the money options, which is the case of a butterfly, the 235 is above price, right? So those calls are out of the money. So if I use that, it's not going to work too well. So I'd like to try what if I do something very close to price, for example, like 225 and 230. Okay, 225 and 230. Let's say what happens if I do that. Okay, so now I get more premium. Okay, now I get more premium, but I would never do that, because problem number one, now you are getting a guaranteed a potential loss which is over 750, so that's worse than before. And best case is in the red zone, meaning that the best case is to lose 200 something. Again, the philosophy of doing those conversions, as discussed last week, is to reduce the risk and give the trade a second chance. If the only thing you're going to do is reduce the risk, but basically you lock in on a loss, that's not a valid tweak. Okay, so what else can we do here? Well, let's see. What if instead of 225 to 30, I do 225 to 27 and a half? Okay, if I do a broken wing or a butterfly, so what would happen well, still my profit zones are still in the red, and the worst case gets now down to $600 of risk, which is worse than what I have now. So it's not working too well. It looks like using $10 of strike price increments is probably the best way to do it, but it also looks like this is not good enough. So I'm going to try my last chance is going to be 230, 235. Let's see if this helps in any way, and if it does, we'll do it, and if it doesn't, so at least this was a great exercise. Oh, by the way, I cannot do this one. If I do this one, I'm just locking in the current outcome. That was so silly of me. I'm basically creating what is called a box, okay, an options box, by doing 230 to 35. So that will not work. So maybe I'll do 227 and a half and 232 and a half. Okay, that will be my last shot, and that will produce, yeah, locking in profit, and then maximum loss is 604. So again, not helping the way we need this to help, which is again the consequence of being way too close to earnings. Yeah, so it didn't work well for us to be able to help this trade. So then the idea is to leave it alone. Okay, and again, let's say tomorrow the market open, or later in the day the market open, and you have a pretty powerful rally, and these rallies, 225, 230, something like that. Well, I'm telling you, at that moment in time, you do the 225, 230, and probably you will end up with a tiny triangle on the green zone, tiny one, but you will, and then the risk may be reduced by close to half, and that would be a valid iron condor converted to an iron butterfly to me. Okay, but at this moment in time, of course, we don't have a case that is justifiable, and therefore we are just going to leave this trade alone at this moment in time, which is the most we can do. That's we cannot do more magic than that. Okay, cool. So I'm going to move to WPM now, because again we cannot do much more to FedEx. But before we do that, or as I do that, as always, I'd like to get some of your feedback, guys. Please go ahead and let me know how is it going with FedEx. I can see many of you were in this trade, so is there any experience you'd like to share? Is there any aha moment that you had during this trade? Is there any remaining question? Anything that you'd like me to re-explain? Please let me know. Again, I'll give you a few seconds to confirm this, especially since a bunch of you have been in this trade, more than ever, apart from all our trades are for practice purposes and so on. But since some of you have been in those trades, I really, really value the fact that you guys not only put time and effort into attending the sessions, but actually to practice, because that's how you develop the skill, right? So I certainly want to be here for you guys, and do not leave any question unanswered. So please let me know. And again, as always, if there is nothing, just give me an okay. Okay, so I'm going to be switching the charts to WPM. I'll be checking the chat box. Okay, guys? And so what do we have with WPM? Okay, so well, for WPM, we need to go back to last Friday, which last Friday was the 25th of February. So the 25th of February was right here. And the closing price was 43.96. In other words, we closed 4 cents below the strike price of the options we were short. You probably remember that we talked about the concept of fake Greeks, and when that is a triggering condition for you guys to roll the 44 call as well as the 39 puts. And you probably remember, if you were live in the session with me, that I said, look, we don't have fake Greeks yet when we're in the session, but I said, but probably we will the next day or something like that. And then it will be time to roll. But I said, I'm not going to do it just in case we get assigned, so I can demonstrate a case of what happens when you get assigned. Well, unfortunately, I did not get assigned by 4 cents, okay, which is better for the trade from a simplicity point of view, but worse from a training or coaching point of view for me, because I wanted to show you what happens when you get assigned. Anyway, I cannot because we closed 4 cents below 44. Okay, so in other words, if you look at my account, okay, if you look at my account and I show you the platform as well as the position, so with WPM, I only have 2 units. I'm long a call, I'm long a put. In other words, if you look at the position that we built, that was made of, buying the 44 call and selling the 404 call in a shorter expiration date, and buying the 39 put and selling the 39 put using a shorter expiration date, and then we were rolling February 18 to February 25, and February 25 we wanted to roll to March 4, right? But we didn't. Okay. So if you did roll, so your trade would now be a risk-free trade. Okay, my issue is that, well, my issue on purpose, right? For education purposes, I wanted it to be an issue. So my thing is that I am left with 2 units only. Okay, I only have 2 units. Okay, because the other 2 options I had that were expiring on February 25, which is last Friday, they both expired. I was counting on the 44 call to be given to me, but it didn't happen again because of 4 cents. So I am now long the 44 call and long the 39 put, which is basically a long straddle position. Okay, but the good news is that that straddle position. So if I was to go back to the risk graph, and here you see my long straddle, right? So this long straddle cost me here 154, right, which is 93 minus 61. But the reality is that I pocketed 54 cents and 24 cents. This has been pocketed because those options expire, so those credits are in my account. And therefore, if you account for that, so on the call side, okay, on the call side, those 93 cents are to be diminished by 54. So the real cost of that call is 39 cents, right? And those 61 cents are to be diminished by 24 cents. So the real cost of the put is 37 cents. So in other words, the real position in which we are in is that position, which has a maximum risk of 75 because the most you paid is 75. And that stock has been moving, and it's currently trading at 45 something. Okay, so now is going to be the time for me to sell the calls. Okay, but we also need to be very well aware of the fact that earnings are around the corner. So we need to have a proper conversation about this trade, because for next week, the type of calls that you need to sell are going to be different. Okay, and you will see why. So anyway, let's do one at a time. So let me float this out. Okay, so we are going to go back to WPM. We are using March expiration. Okay, I mean, we are 1 day to expiration, so selling an option with 1 day, it's not going to be that amazing. But anyway, also notice the bid-ask spread is quite wide. Okay, so in a normal case, okay, let's say this was Monday, which this is when you would normally do this, right? So what would happen? Okay, I'm just gonna go ahead and compare spread. So what would happen is that you would sell using March 4. You would sell a 39 put, and using March 4, you would sell a 44 call. Of course, the 39 put is going to pay nothing at all because the stock is trading all the way at 45 plus, and we only got 1 day and a half to expiration. So the 39 call is going to pay just a few cents, 8 cents. But the 49 call is going to pay a great amount of premium because it's in the money, right? Because the stock is trading at 45. It's deeply in the money, right? So what are we going to do with that? Well, if you do that, look at the beauty, okay? So this trade, let me expand it. The orange graph, okay, notice how the orange graph now shows us that this trade cannot lose any longer. Okay, so worst case, let me see, one sec. So right here, so worst case, okay, this trade is going to make $72. How come? Well, very simple, because the cost of the trade was 76, but now we are selling two new options and collecting 137 and 108, meaning that now this trade is going to become a credit, and depending on where the price of the stock is, we're going to end up with a specific profit, which at the minimum is going to be around $70. So no risk anymore on this trade. Okay, sure thing profit as we sell those options. Okay, sure thing profits as we sell those options. Now, if I sell those options, all right, so what's going to happen? And let's say the stock ends up trading at 45 something. The current price of the stock is 45. So if I sell those options, right, my position will be the old 44 call that expires in March 11 we have, and the old 39 put that expires in March 11 we have. So this is what we currently have. If I sell now a new 44 call that expires on Friday, tomorrow, and I sell a new 39 put that expires on Friday tomorrow, so what's going to happen is that on Friday tomorrow, the 39 put will expire out of the money, and therefore next Monday I can sell a new one. But the 44 call, right, won't expire worthless. It will expire in the money, and therefore it will be auto exercised. Sorry, it will be assigned. So assign, okay, means that you will find yourself short shares, okay, short shares on Monday. As I explained last week, it's not a problem because short shares on Monday plus a long call, that is limited risk. And again, because you're selling the call when the call is in the money, actually is a sure thing profit. So it's not a problem at all, but there is a margin implication as discussed last week, in the sense that in order to be short shares at 44, you need to come up with 100 times 44. I mean, half of that, because it's going to be a margin account. So there is a margin implication, there is a buying power implication that you need to keep in mind. So in a normal case, this is what you would have done somewhere during the week, right? Now the stock moves, okay? Now the stock moves, and you end up in that particular position where on Friday that option is assigned, and then you find yourself next Monday in the very same position I explained last week. So I don't want to re-explain the whole thing, okay? It would be exactly the same. The only difference is that last week, by selling it last week, you would have collected a few cents that would bring in the risk of the trade to be barely break even, as we calculated. Where today, since it's deeply in the money, selling the 44 call would basically guarantee a $70 profit no matter what. Okay, so you have that, pros and cons, because it's all about timing in life. It's all about timing. In trading, it's all about timing, and we are doing this session at a different time. So that's the case, okay? But instead of doing that, I want to pretend, okay, it's next week, because what I'm explaining now is the same thing I explained last week. So I want to pretend it's next week, right? And what is it that you're going to do? Because what's going to happen next week is that we have earnings being reported on March 10, okay? Which March 10, it's before March 11, being March 11 the expiration date, okay? So we need to talk about that, so we can play this as smart as possible, because here is the issue, okay? Next week there is one thing you cannot do, okay? Let me show you what is it that you cannot do next week. So what you cannot do next week, okay? I'm just gonna copy primary spread, okay, which is again when you only have one call and one put, okay? So what I was to do next week is to midpoint using March 11 expiration. If I was to sell the 44 call and I was to sell the 39 put, okay? So if I ever do that, using March 11, sell the 44 call and sell the 39 put using March 11, well, notice what happens to the risk graph. Sorry, I made a mistake. Call. I'm like, this cannot be. Okay, you'll see now. I mean, flat line. You see that? Flat line. This is what's going to happen if you do it. How come flat line? Well, because, my friends, selling the 44 call, if you own it, it's the same as saying you close the call. And selling the 39 put, if you own it, is the same as closing the 39 put. Okay. So what have we done? We've done. We are now reaching to the end of the life of this trade, which is or was a double calendar, where we bought the 44 call and sold the 44 call using a shorter expiration date, and then we bought the 39 put and sold the 39 put using a shorter expiration date. So we did that. We've been rolling every week the short units, every week. This brought the risk of the trade to be lesser and lesser and lesser, potentially last week to break even, this week to share thing profit. And now you are about to do the last roll using the last expiration date, which is March 11, but the last roll cannot be done with the same strike, because if you do it using the same strike, basically that means that you are closing the trade, right? Closing the trade. And while that's okay, while closing the trade is okay, it's a profit. So if you close it, it's fine. Well, if you close the trade, the thing is that you may be missing on what sometimes happens with earnings, which is a large move. So how can we try to capitalize on a large move? How can we try to do that? Well, one thing we could do is, as an exception, instead of selling the 44 call that expires in March 11, we can go one strike beyond and sell the 45. And in the bottom part, instead of sell the 39, sell the 38 put, which is one strike below. This only applies to March 11 expiration, which is the last expiration available before the original long units expire, which is coinciding with the expiration date, as we did on purpose when we were building the trade precisely to come to this particular situation. So, and I see messages on the chat box, so coming back to this in a moment, but let me simulate what happens if instead of selling the 44, I do 45, and if instead of selling 39, I sell 38. Okay, so 45 and 38, click OK. And now take a look at the risk graph that we have. So we end up with a sure thing profit of 82. That's a sure thing profit. And then if during earnings the price was to be rocketed higher or rocketed lower, and that is below 38 or above 45, right? Correct. Let me rephrase that. Below 39 or above 44, I'm like, that cannot be. Okay, so then you can get an extra increase in the profitability, which is 122. Okay, so this is one scenario to evaluate. Of course, depending on the levels of premium, this choice may make sense or may not make sense. Because again, if I go back to what we said a moment ago, which is sell the 44 and sell the 39, so we just said that we'll be locking in on a profit of 150, which locking in on a profit of 150 is more than 122. So why would you do that? You just take 150 and run. Okay, but why is that happening to me? Well, it's happening to me out of luck. Okay, why luck? Well, because since the last Thursday until today, I am on a long strangle position, and that stock basically rallied pretty hard, especially on that day. And this is just me being lucky, being on a long strangle where I should be with short units to, collect time decay and so on. In case the market didn't rally, I would definitely want to be with my short units. I was not in the short units, as I said, on purpose, so I can demonstrate assignment, even though because of 4 cents I could not, right? So basically what my case right now is just a lucky case where if I close the trade now, I'm going to make more money than if I didn't close the trade now. But again, I'm not here to make money, guys. I'm here to teach you how to utilize the options markets, how to utilize the technology, how to evolve your trading plans, how to manage your emotions. I'm here for many more things than just collecting profit. So what I'm going to do is I'm going to pretend I didn't get lucky and therefore move to that scenario where you would sell one strike above and one strike below. And now you convert the double calendar into what technically is now a double diagonal. Okay. It's actually a reverse double diagonal. And you would now make maximum. Wait a minute. The prices have moved a lot now or something like that. Yeah, 84 to 178. Okay, so I'm not sure if this is because the stock has moved or suddenly lots of implied volatility kicked in. But earlier it was 90 to 122, and now I can see it's 84 to 184. So right now, actually, there is more money to be made. So perfect. In any case, I think it was a good conversation that I talk about, the little luck that happened to me from the last Thursday when we met until today. Okay, with being a long strangle, which typically is a very bad strategy, because the only way a strategy which is a long strangle pays you is that the stock moves very fast, which in this case it did. Okay, normally stocks don't move that fast all the time. Okay. So this would be the type of trade that I would like to put in place. Again, I'm going to execute this trade in just a moment. I want to go back to the chat box and make sure that it's all understood before I execute the trade. So let me read. Christian, I see questions related to FedEx, okay, but I see a question related to WPM. So let me go backwards. If you don't mind, I will answer your question related to WPM first, since we are dealing with WPM. And then, sorry for being late reading your prior chat. Then I will go back to FedEx. So WPM, wouldn't your final move imply a whole new trade as it banks on a move based on earnings? No, I will not do that, because if I was to try to make a profit based on a potential move that may happen with earnings, then I'm just being as hopeful as many retail traders that, just buy a strangle or buy a straddle or buy whatever, hoping for a move to happen. That often, beyond often, I would say most of the time actually doesn't work well. Okay, that most of the time doesn't work well. And by the way, you can actually backtest that. Okay, so you can you probably know this because of the prior session, Christian, but just for everybody, so you can get into options earnings replace, and be like, okay, what if I buy a long straddle on WPM and I do that every single quarter? Would that work or not? And so this one would have worked, this one break even, this one a little profit. Okay, so well, two out of three kind of in this case. But again, with many other stocks, I am telling you, most of the times, it is not the case that this would work. Okay, and when this doesn't work, on top of that, often the losses are quite large, because buying a straddle or a strangle means that you buy two units, not only one but two, and therefore, you have double the risk, etc., etc. If you buy it too far, too soon, you got time decay killing you. If you buy too close to earnings, you got too much implied volatility. So it's a very difficult trade to make work. It's a very hopeful trade. You don't know what direction the stock is gonna move at, and you wanna make a profit out of that. There is a lot of hope built in. Many hopeful traders are doing that, and therefore often it doesn't work. I mean, there may be, if you do research, and that's why we have the options earnings replay, there may be some very specific stocks that not too many people trade during earnings, that are liquid enough to be traded, that you run the backtest, and next thing you know, you find a little gold mine somewhere, some stock that happens to work very well with this application almost every quarter. This could happen, and this would happen if you do that work, okay? Even though it's a lot of backtesting. But in most of the cases, it would be a waste of time. So what I'm trying to do here is I'm trying to find a balance, which is I am now nearing to the end of this trade. The reason why the trade that we put together, this double calendar, is making money for us is why? Well, remember, going back to day one, when we set up this double calendar, double calendars are trades which are loaded on Vega sensitivity. So on volatility sensitivity, so if volatility goes up thanks to great Vega values, you make a lot of money, while as you're waiting for this to happen, we kept selling short-term options and collecting time decay at a pretty fast pace because those were weekly expiration options. So the two things combined get you to a point where you are making a profit, maybe not too great, but making a profit or breaking even, typically making some sort of a profit. And now that you are making some sort of a profit and you cannot lose anymore, so now you sell two options that are beyond the strikes. So if a move on earnings happen, you're going to make a bit more. But notice what I said, you're going to make a bit more. I'm not trying to ride a whole crazy earnings move that sometimes happen and make 5,000% return on an option. I mean, could that happen? Yes, but that's going to be a rare event. So instead, I'm trying to position myself to an increase enhanced profit, okay, from I think it was 70 to 80 something in this case. And if the move takes place, I can make up to 180, which is the extra profitability thanks to the earnings move. But I'm trying to make that extra profit with no risk, with no additional risk, because my risk is actually to make $80, positive $80, not to lose $80. Okay, so that's the balance I'm trying to find. I'm trying to build myself to be in a position where when earnings are about to happen, I can profit from the move with no risk instead of trying to profit from earnings out of taking a major risk because options are too expensive or I buy them too soon and therefore I'm going to get killed on time decay. Long conversation, okay, but hopefully this helps you to understand where I'm coming from with this type of application. And you can see with the evolution of the trade, the reasoning, why we build the trade the way we did, why we use the expression days that we use the way we did, etc., etc. Okay, so there are more what if scenarios, such as what if you get a sign in the process, which I was trying to get a sign. Of course, I cannot control price movement, so I didn't buy 4 cents. Hopefully on the next trade or the next one, we will. Okay, very good. So let me go back to other comments there. Thank you, Christian, for confirming you got it. Cool. And okay, and the other comments were related to FedEx. Okay, so let's do this. Let's place the order in. Okay, so instead of March 4, we're going to use March 11. I am long the 44 call, so I'm going to sell the 45 call against, and I am long the 39 put. So I'm going to sell the 38 put against. This is going to pay me 158, assuming I get filled at the midpoint. So I'm just going to place that order in. If I don't get filled quickly, I'll just move the prices so I just get filled. You know that I often don't treat very well the demo accounts that I use for demonstration purposes, okay? Because, I give priority to have the trades in so I can comment on the management. You guys realize how important the management is, isn't it? So I really, don't care if I don't get filled at a fine price. I just want the trade in so I can discuss it in future sessions for you guys. So anyway, let me move this credit down to maybe 150. Hopefully I get filled like that. Okay, the 38 put has 0 bid. So again, it's gonna be difficult to get filled on that one. I'm just gonna do something crazy. Okay, you guys, please don't do that. I'm gonna try to push and force with a market order the simulated account to give me the field so I can get that in the account. Never do that with real money, guys. Okay, I'm just doing it so I can have the trades in the account so we can comment on next week with a market order. This is absolutely crazy. I just got filled at 152. Thank you very much. And the prices I got is 7 cents and 145. Okay, so let me document that. So 145. Okay, 145 and 7 cents. Here we go. I got it. So I'm going to copy position to the clipboard, go back to top, go back to the positions panel, and I'll put that in the bottom part so we can continue reviewing this trade in the following sessions. Okay, cool. Okay, so this is, I'm done with WPM, and I can see your questions on FedEx. So let me take care of that now. Back to FedEx. So Christian said, not sure. Oh, wait a minute. Mark, you have a question related to WPM. Let's go back to WPM then. Okay, so make sure so clear. Made a mistake. Only have the 11 March 39 put left. What does that mean, Mark? It means that you closed the call. You closed it by mistake. Maybe you wanted to close the short call to roll it to the next expiration date, and you close the long call, maybe, or something like that. Is that the case? Obviously, if you only have a put left, well, obviously it means that you close the call because that call got you. I understand. If that call was um, um, auto exercised for you, um, then you will have long shares in the account. So if you don't have long shares in the account and the call is gone, then it means that it was indeed a mistake. Okay, but it's okay, guys. It's okay, and I appreciate you, Mark, being open to point at the mistakes you make, because we all make mistakes, including myself with experience. Sometimes we are human, we make mistakes, and those are good learning opportunities to create routines, methods, ways on how you do the trades and things like that. So those mistakes happen the least as possible, because mistakes in trading, obviously, they cost money. Okay, so thank you very much for sharing. So also the other traders in the room, they can pay attention to these type of things in future trades. Now back to FedEx. Okay, and back to Christian. So Christian says, not sure it was smart to stick with FedEx given a complete meltdown in the market. My lessons is that even non-directional needs to respect that. I get you. There is pros and cons in everything we do in trading, Christian, and this is the natural consequence of not knowing the future for sure, right? So when you don't know the future for sure, you basically got two choices. Let's put it this way, okay? And it's a very simplistic way to think about it, but hopefully it helps. So one way is to just rely on the evidence of what's happening and take action. And in that sense, you may have a rule that says, look, if price gets to my purple line, right, or whatever, the first UFO in this zone is violated or whatever rule, then I'm just gonna get out manually and that's it, because you are being proven that the non-directional setup is not acting as non-directional anymore. Okay, so if that's your way to look at it, to me, as a trading plan, trading rule point of view, it does make sense. Okay, so which is basically what you said in your message there on the chat box. So I have nothing to say to that when it comes to like if I was to see it as a bad rule or a bad reason, bad method for a certain reason, I would mention it to you. I don't see any reason of that sort. So in that sense, you rely on evidence and you get out because of that evidence. That's it. So option number one. But now what's option number two? Well, option number two is, instead of the evidence of what's happening, you can look at the evidence of the statistics suggest of what may be happening next. And when that move is going down like crazy around this candle here already, so you are already hitting 2 plus something on the max distance, you are already way beyond 9 candles on the climate. So again, statistics suggest that this should turn more often than not. Okay, and again, we've seen it that sometimes is not the case. For example, in this case. So what do? Well, in the end, you need to have rules and preferences, and often they have to do with your mindset as a trader. In my case, with my mindset, and again, we are all different, and it doesn't mean that what some of you do is wrong, or what I do is wrong, or what I do is right, or what you do is right. It's just like trading is very personal. As long as you have the rules and you manage your risk, you should be fine, and that's what matters the most. But again, just sharing with you, the reason why, to me, it was okay to stick with the trade is because when statistics suggest the next thing to happen is often the opposite, which is this case, right? So much red on the climate implies that the next thing to happen typically is blue. So when that happens, typically it gives you good opportunities to convert your condor to a butterfly or another type of condor or something like that. And then next thing you know, you are in a scenario where you lower the risk and you give the trade a second chance, and you'll have many cases where those trades end up in a profit, a smaller one sometimes, but they will end up in a profit, or maybe as a lesser of a loss as well, which is also nice. I am willing to be exposed to that, given my personality, my trading style, and so on. I could understand some of you that you don't want to, let's call it, waste your time, and it's like, okay, this trade disappointed me, it's not doing what I wanted to do, I'm out. No problem. That makes sense too. Okay. Um, yeah. So again, two styles, two different ways to think about it. Certainly, very valid point, Christian. I appreciate your comment. It makes a lot of sense, and it's indeed a valid way on how to manage your trades. I see it as a very valid approach. Christian, another lesson. I should have tweaked it earlier. Had it actually set it up and could have reduced the risk by half, but wanted to see if you would do it, at which point it was too late. Got you. Yes. Yes. Again, we talked about this as well. And this, guys, is the consequence of we meet once or twice a week. I mean, when you do this type of trades, ideally you look at it once or twice a day, not once or twice a week, once or twice a day. And when the market was going down like that, already we had opportunities to lower the initial calls that were higher. So as you are doing that, okay, so normally you end up lowering the risk of the trade. And if in the end you cannot even tweak it at the end, at least you still worked on lowering the risk of the trade. And in this case, you would have ended up in a better position. So mm, that's my favorite approach. That's my personal style. But again, I could totally also see that some of you guys, maybe traders that are just keeping it simpler. If you recall, years ago, okay, and some of you were part of our community already at that time. So if you recall, years ago, we were meeting very, very few times to do live trading together. We didn't have as much trading technology developed at that time. We only had the UFOs on TradeStation, for example. And talking about TradeStation, by the way, I'm going to be doing a webinar in a few hours with TradeStation. In case you guys are TradeStation clients and you want to join me there, it'll be a happy moment for me to see your name there. But anyway, coming back to what I'm saying. So years ago, where we only had one tool, we only had very few sessions a month to get together to do the trading. So of course, I could not do magic when it comes to teaching so many alternatives because of the tools and the amount of time spent together. So I remember that we did, for many cases, we did a set and forget type approach when it comes to iron condors and many other type of trades, where you put a trade in place and you just forget about it all the way to expiration. Obviously, it's absolutely not the most efficient approach on how to use options, because you are missing on all the tweaks that we are learning to do from a trade management point of view. But certainly it's a valid approach if your setups are valid, your reward risk ratios, etc., are valid. So actually, this was producing returns, isn't it? If you recall. So again, going from an extreme where you set and forget and you forget about it all the way to expiration, to you are very active on tweaking and you keep the trade all the way to the end, even if it's working against you, maybe somewhere in between is what you're mentioning, Christian. And all those various styles have pros and cons and are valid approaches on how to do it. Okay, so I love the conversation, guys. This is very enriching, and hopefully you guys are also enjoying it very much. Thanks for that, Christian. On FedEx, the puts IV were always above the calls. Yes, this happens. Okay, this when you look at the skew, you can see, for example, in this stock, it's very clear. It's not a volatility smile at all. It's just a drop. Okay, it's just a drop. And when you add the put side, sorry, let me put it together. Okay. When you add the put side, well, now that we are nearing expiration, to be honest, the put side is actually higher than the call side. But I do recall looking at this particular graph earlier in the life of this trade, and you are absolutely right, Mark. Well, actually, I'm just getting confused for a moment on different parts of the conversation. Sorry for that. This is exactly what you just mentioned here, Mark. The put implied volatility is significantly higher compared to the call implied volatility. So it's still like that. There was a time in the life of the trade that it was not like that, but it is like that now. You can also see it on the volatility comparison, where since some time ago, since February 16 or something like that, the implied volatility for the put, the gray line, is clearly above the blue line all the time. Okay, so that obviously makes it more difficult to use the calls to offset the problem. Okay, but in my case, the problem really is that I acted on this trade way too late, way too many times, because meeting only once a week, I just could not do it on time. Okay, so but anyway, that's what it is. The thing about these trades, of course, it's always fun, even when it's paper money, to make some money. But really, to me, the real value of these trades is that you understand the mechanics of managing your trades, so you can practice that in your accounts. Because again, as we said many times in the past, if many times a year you have cases where a specific loss ended up as a smaller loss, or a specific profit ended up as a greater profit, or a trade that was supposed to lose ended up with making a little bit of breaking even at the end of the year, that's a very, very big difference. Okay, so yeah, so that's my point here. Okay, yes. And the webinar, yes, is on the TradeStation platform called You Can Trade. You're right. I can send you, if you give me 1 second, I can post on the chat box the link for registration. I guess that would be useful to you guys. So let me find the link very quickly so I can post it. I should have thought of this before. Okay. Here we go. Here's the link. You have it there. So that way you can register for the session and see me there. I have to tell you, my friends, the session will be basic, okay? Because obviously it's a generic webinar with You Can Trade, so you will probably not learn too much when it comes to advanced stuff. But if you got nothing to do and you want to join me there, again, it'll put a smile on my face to see your names in the chat box. But please do not feel obliged, okay? You guys are more advanced than what I plan to cover in that session, okay? Very good, my friends. Again, as always, real pleasure to spend some time with you. I will see you in the following session. Don't miss Josip tomorrow. Great session coming with him as well. And keep up the good work, guys, and keep counting on us. I almost forgot two comments. We will be releasing soon an update of top. I think I mentioned at the beginning of the session, but again, Mark, the link didn't work. I guess they are not accepting registrations anymore then, because that is the link. Yes. Let me try while we are talking. I'll try on my end. Yeah, you're right. That it doesn't work anymore. Yeah, doesn't work anymore. Sorry, guys. Maybe you want to check the website of TradeStation or youcantrade.com, and maybe you find it there. I would not know where the link is at this time. The event is happening in just a few hours. They may have stopped the registration already. Not sure. Again, you won't miss too much. As I said, it's a basic session to talk about calls and puts and buying calls, buying puts, things like that. Is very, very basic. But sometimes it's good to go back to the basics. And again, if you find the link and you want to join me, again, it makes me very happy. Going back to what I was saying, Mark, you had a problem with SPX options the other day. We found the issue. We'll release an update that will fix that. And also, there was another issue with the risk graph, isn't it? A few of you commented with the calculation of the risk on the right side of the screen and so on. So we are working on a different way on how to process the data, so the values can be presented in a way that is not confusing, where the values match, etc., etc. So just keep that in mind, and that way, the issue will be solved. Okay, we'll be releasing an update very, very soon. Thank you guys for using the platform to the full and maximum power, and for finding some of the areas of improvement. And for sure, we are committed to keep, just having the finest software and very powerful tools for serious traders. So please keep sharing anything that you see from an issue point of view to a suggestion point of view. Believe me, we'll keep all those considerations for the future. Okay, so don't be shy to get back to us. Yeah, and working on the website, I'm so excited that we will, in a few weeks, hopefully, touching wood, release a new version of the website that will be faster, less buggy. I know some of you had issues, so I'm very, very excited. We are changing a lot of pieces of technology inside our website believe it or not, there are many things going on our website, and I'm very excited to get that new release in a few weeks from now. And talking about that, and Joe was asking, Joe, you are with us today, isn't it? Yes, I can see your message there. Joe was also asking if we could add some sort of a functionality for you guys to meet, for you guys to chat, for you guys to share trades and things like that. So I wanted to share a link with you guys since we're all together in the session. So you take a look and you tell me what you think. It doesn't need to be that. Okay, give me a second. So I'll share another link with you. It doesn't need to be that tool, but I would love you guys to take a look at that tool in case you like it. Okay, and you guys tell me, feel free to email me. Discord is certainly a valid tool, but it's quite complex to use. I have seen many complaints from many users that is quite complex. Okay. Yeah, Mark, Merlin and Corey may or may not know top exists. Also, they may or may not see top as a tool that may cannibalize their own businesses. So I'm not surprised they will not talk about it. Fair enough, not an issue at all. Okay. Again, I'm a strong believer that it could help many traders, as I'm probably pretty sure that you guys believe the same is true. But again, different professionals have different opinions, and it's fine. So again, coming back to the link I just shared, there is a website called stocktweets.com. We have created what's called a trading room where you guys can post screenshots, can comment on trades and things like that. I'm curious if you guys want to use it for a few days and see what you think. Doesn't need to be like that, but and if you have any suggestion of platforms that we could use for you guys to get together, let me know. I'm looking at creating something that maybe we can embed on our website, and it could be quite neat for you guys instead of having to use external software or something complex as Discord, which is very powerful and very nice. But I heard many complaints from traders as well, where you want to do something simple, and next thing you know, it's very complex. So I'm trying to use or create something very pragmatic, very convenient for you guys, and very happy to hear all your suggestions. So please let me know. My friends, thank you for your time. I took 12 minutes extra of your time, so thank you for that. See you soon. Keep up the good work. Count on us. And yeah, let's kill it out there, okay? And be careful with the volatility in the market, okay, guys? There is a war happening. It's not a joke. Make sure more than ever that you rely on market data, statistics, climate, UFOs, everything. Do not anticipate. Do not, as one of my instructors said once, do not be the guy carrying the flag, the first on the line. Okay, so just make sure you got enough evidence to take your trade safely. Manage your risk, guys. There is, unfortunately, because it's very sad, there is a conflict, but that as a trader is also a source of opportunities. So let's do it well. Let's not be greedy, okay? So we don't get in trouble. And my friends, take care. See you soon. See you then. Bye-bye.